From New York City for our viewers worldwide, I'm Matt Miller. Futures doing a whole lot of nothing, waiting for the data. The countdown to the open starts right now. Coming up, U.S. stock bulls get even more bullish after Evercore ISI and Goldman Sachs boost year-end targets for the S&P. Traders staying cautious, though, in Europe as they digest comments for France's far-right leader Marine Le Pen. And Fed speak picks back up again this week with 8 members set to give their comments. Is the data more important? We begin with the big issue, markets taking a pause as the Fed indicates it is in wait-and-see mode.
We're in a very good position right now to take our time, get more inflation data, get more data on the economy, on the labor market before we have to make any decisions. So we're in a strong position. But if you just said there's going to be one cut, which is what the median indicated, that would likely be toward the end of the year.
Joining us now is Kristina Hooper, Invesco Chief Global Market Strategist. And Kristina, thanks so much for coming on the program this morning. What do you think about the path and the sequence in terms of rate cuts? Is Fed guidance even as important as the data points that we're going to get?
I don't think it is at all. I mean, all we have to do is go back to December of 2021. The Fed anticipated in its dot plots that by the end of 2022, the Fed funds rate would be 90 basis points, and it was about 430 basis points. So we know the Fed can be wildly inaccurate, and so I don't pay a lot of attention to it, especially, if I think about the Fed's projection on core PCE. It has ratcheted that up from 2.4 to 2.6 to now 2.8. So that suggests to me if we get any improvement in disinflation, there should be merited more than one rate cut, because they're assuming one rate cut with no progress on disinflation. So I'm fairly positive on the outlook, and I'm not a believer in the Fed dot plot as being the be-all and the end-all for sure.
So do you see inflation slowing down maybe more than the Fed? I mean, they have to be cautious, especially after what they've gone through, right? Do you see inflation coming back down closer to 2% in the next couple of years?
I do, absolutely. Yeah. It's going to be an imperfect path. At times it's going to be ugly, but it will come down. We're removing stimulus. We're doing everything that historically has resulted in a reduction in inflation. So I think that's going to happen this time around. But there will be certainly data points that disappoint. But when we take a step back and look at the trend, I think we'll get to a place where the Fed is able to cut probably 2 times this year, in my opinion.
By the way, does your inflation outlook change depending on who wins the election in November? Are there multiple scenarios?
There are multiple scenarios, but it does not depend on the election in November. Our expectation is that monetary policy is doing a lot of the work, and what we've seen in terms of very aggressive tightening, it's taking time to work its way through the system. But that's really the large driver. That and the with removal of the significant fiscal stimulus we've seen is enough to get us to a point where we're moving closer and closer to the Fed's target.
All right, I want to get over right now to Michael McKee because we're getting our latest reading on the strength of the consumer with retail sales out tomorrow. The data, as Kristina says, may be more important than what the Fed actually tells us. Michael is Bloomberg's chief economics and policy correspondent. So, Mike, what data are we going to be getting?
Well, retail sales is the big one. We had the week kickoff with Empire Manufacturing, better than expected, but still negative. That's not a major indicator for anyone in the markets, but it is something to trade on today. Retail sales tomorrow. The big event of the week is the consumer hanging in there. We get good news from basically the credit card reporting banks, but Bloomberg Economics thinks it's not going to be good. So you pays your money and you place your bets for tomorrow. Wednesday, get the day off. So that'll be great. Wear sunscreen. Thursday, jobless claims is going to be interesting just because we had such a rise last week that we want to see what happens. Is that a trend, or is it like last year, just sort of a seasonal thing? Again, retail sales, the forecast is for things to get better. We're expecting the control group to be up 0.4 after declining last month. So this all tells you that if that comes to pass, that the Fed can stay on hold. It's not going to make a big difference. We are going to hear from the Fed, of course, as you mentioned, an awful lot of Fed speak this week as they come out of the quiet period. But does it mean a whole lot? We'll get their views on retail sales probably, but do we see any kind of change in what the outlook is? I don't think so, not this week. It's the inflation numbers and the jobs numbers that the Fed is watching. So we'll get a lot of information, but do you act on it? Going to be up to you. I did throw on the Bank of England there. They have their decision on Thursday. And after the ECB cut, and there's some thought that the Bank of England's getting closer to cutting, there'll be some debate about how that affects the U.S. economy and the Fed, but probably not much.
All right. We will talk about that for sure, how the international picture affects the U.S. economy. That's in our next block. Michael McKee, thank you very much for that. Kristina Hooper, Invesco Chief Global Market Strategist, still with us. And Mike showed that there's some housing data coming out on Friday. I saw last week applications for new mortgages soared. And I'm just wondering, is this economy getting used to these interest rates? Old people like us refer to them as normal, right? But for the kids, this is not normal.
This is not normal, but life moves on. So I think for a certain cohort, they are starting to purchase. I think part of the catalyst, though, is an expectation that they'll be able to refinance in a year or two because they anticipate we're at the cusp. We're at the start of a rate cut cycle. And so that they can tolerate higher mortgage payments for a short time.
So I wonder how earnings, your view on earnings is, because we're starting to get higher and higher targets. Yesterday, Julian Emanuel put out a target of 6,000 on the S&P. Kind of blew my mind because he was at 4,750, right? That's a little bit of a capitulation. His basis is that earnings are really accelerating this year and are going to continue to accelerate next year. I think 8% gains for this year and 5% gains for next year was his thesis. What do you see in terms of earnings?
So I would anticipate an improvement in earnings. What we saw recently was that one company was the driver of a significant portion of earnings growth for the S&P 500. So an expectation of a broadening does get us closer to his targets. And so I think that's a very possible scenario. Also, keep in mind that if we do see that start of rate cuts, if we start to see the 10-year yield come down, that gives the S&P 500 more room to run as well.
Right. So the broadening, I guess, is important, right? We're looking at a 24 price earnings for trailing earnings right now, which is historically pretty high. But if you look at just the Magnificent Seven, as they're called, they have a PE of 36 for trailing earnings. So the 493 aren't nearly as highly valued.
Absolutely. And so if they're able to contribute more, then that helps justify higher PEs. Now, I will say this also argues for investors looking abroad to make sure they have exposure to areas that have far more attractive valuations. And I think Europe and the UK are attractive destinations because they are not only attractively valued, but their cyclical exposure is higher. So if one assumes that we're going to see a reacceleration in global growth, we're going to see a reacceleration in European and UK growth, that's an attractive place to be.
Hey, do you still, I mean, I want to talk a little bit about this in the next block, so maybe we'll save that, but do you still see a broadening out in terms of regions? Because we're all worried about, you know, Le Pen winning in France, and you've seen yields go crazy over there, value wiped out from the French stock market.
Well, this is certainly a time of uncertainty and instability, but once we get greater signs that there could be stability, that when we get past this election, things look fairly smooth, I think that we'll look back and say this was probably an attractive buying opportunity. I think of this as a very short-term period, a blip. But if we look beyond this, there is a lot of potential. And I wouldn't want politics to get in the way of investing because the time horizons are so different.
Are we all being a little bit too Pollyanna-ish in terms of, worries? I heard Larry Summers say that Donald Trump is the most inflationary presidential candidate in his memory, and he's not young. Obviously, the worries about France, even though Le Pen seems to be coming back to the center and saying she's not going to spook institutions. I mean, this is really when you get great opportunities, right? When the whole world's freaking out if you don't.
Exactly. Absolutely. And I think what we've seen from history is that typically when you put on political blinders as an investor, you get better performance because you're not subject. You don't get spooked. You don't move out when you shouldn't. You take advantage of opportunities. It's hard to do. You have to have intestinal fortitude. But I do think historically it has proven to be an appropriate and prudent strategy.
What do you think about portfolio construction right now? I noticed in Julian's note yesterday, he said convexity is a must, which is kind of confusing and if you're not, deep in it. But basically, he's saying, like, put on magnification trades, right? Really boost your bets on this AI thing, which has already run so far so fast.
Well, I think it's very important to be diversified and to look at your portfolio and ask, when have I last rebalanced? Do I have extreme overweights? And ensure adequate exposure to areas that have been overlooked for years, like small caps, where you probably are underweight just given performance in areas like technology. Now, having said all that, I do think that pursuing themes like artificial intelligence is an attractive additional component to a portfolio. And it is sensible to continue to have those exposures, but you don't want to be extremely overweight. Probably many investors' biggest overweight right now, though, is cash. Right. It's always prudent to have a reasonable allocation to cash, but many are way overboard in terms of cash exposure, and this could very well be a time to add that in.
Is it harder and harder, though, to tell your clients to be diversified? I mean, putting all your eggs in one basket has been paying off for a decade now.
It is absolutely harder and harder. But having said that, when we do go through periods where, like 2022, that is a reminder to investors that there are benefits to diversification. And, of course, we are looking out on a different kind of market environment, driven by changes in monetary policy, normalizing of economies and policy, and that could very well offer opportunities. We like to think of it as opportunities amidst divergence.
All right, Kristina, you're going to stay with us because I want to talk more about what's going on internationally, and you have great experience there. Kristina Hooper from Invesco. Joining us now, though, with a look at the stocks, individual stories moving ahead of the opening bell is Abigail Doolittle. Abby, what are you seeing?
Well, it's interesting, Matt, because we have the futures basically flat, slightly down, NASDAQ 100 up ever so slightly, but we have a lot of big names that are higher, including the shares of Autodesk. This on the news that Starboard Value has taken a roughly $500 million stake in the company. They are pushing for changes to the board, given some of the operational challenges, plus the way that they have handled the accounting probe. But that's not it. Let's take a look at some of the other big tech names in the news this morning, or on the move, I should say, starting off with the shares of Broadcom up, heading to a 7th up day in a row. Of course, they put up that quarter and that guide last week, having a lot to do with AI strength, investors liking that. Speaking of liking AI and chips, NVIDIA higher once again, vying for that spot for the world's second most valuable company. Microsoft on Friday first, Apple second, NVIDIA third, but we have Apple trading higher. And of course, Bloomberg News' John Arthur is talking about the momentum, the tremendous momentum, momentum carrying Apple higher today. But I'm not convinced it's going to keep going. We'll have to say. Well,
we're going to come back to you for a look at the charts on that for sure. Abigail Doolittle looking at some of the individual movers this morning. Coming up, we'll talk more about France. It's on everyone's tongue this morning. Marine Le Pen adding new supporters in that country.
We've been here before in the euro area, and every time you kind of investors sense there may be some crisis down the corner. We saw it with the elections in Italy when Meloni won. It doesn't ever really pan out.
More on the political upheaval in France and what it could mean for investors next. This is Bloomberg.
We have seen cohabitation before in France. we haven't seen it in this kind of setup, whether it's the far right or the far left that wins. Both have fiscal policies that are pretty extreme in some cases. But the reality is that we've been here before in the euro area, and every time you kind of investors sense there may be some crisis down the corner. We saw it with the elections in Italy when Meloni won. It doesn't ever really pan out.
All right, we're going to continue talking about what's going on in Europe. Citi has downgraded the continent from overweight to neutral. The bank strategist saying they prefer growth-oriented U.S. stocks. So just when it looked like investors were going to go back to Europe, it seems there's another boogeyman pushing them back. Marine Le Pen is that boogeyman. I think it's safe to say gaining momentum ahead of the French legislative elections, snap elections that Emmanuel Macron called after the EU election drubbing he took and other centrists took. Alan Katz is Bloomberg's Paris bureau chief. He joins us now to talk about really this it seems like chaos, Alan, that Macron unleashed in the way it's been compared many times to what David Cameron did with the Brexit vote, and he lost that one. Why would Macron have done this? Isn't he worried?
Well, I certainly hope he's worried at this point if he wasn't worried in the beginning. The answer to that question about why he did that is a really tough one, and it's hard for many people to really get their heads around it. It was funny, there was an interview I was listening to on Sunday with Finance Minister Bruno Le Maire, and kept getting asked that question. He was saying, well, this was the decision of one man, the one man who has the authority to do this. That man's Emmanuel Macron. This is one man's decision. He repeated that over and over again. And so it really is the case that this was sort of Macron decided this. He didn't really ask anyone. And as you say, he sort of unleashed this really chaotic moment in France that that most people feel didn't really have to come this way. It really feels like it was sort of as you said, it's sort of a Cameron-like, self-made moment of chaos that's happened here.
Well, and now Le Maire and others are out, I guess, promoting a new project fear, a French project fear, right, to try and get voters worried about Le Pen and the national rally. How is it going? I mean, do we know now if they're gaining momentum, if they're losing momentum, who's going to win?
So we don't know that yet. I mean, one of the things that is always true in these kinds of elections in France, that they're very complicated to tell ahead of time how things are going, because it's a two-round system. So it's very different than, say, the U.S. system, which is a one-round system. You go to the polls, the Tuesday in November, and then you elect the president and Congress. Here, you go to the polls the first time on a Sunday, and then you elect essentially people for a runoff vote that then happens a week later. So it's very hard to tell. There have been some early polls, and they've shown Marine Le Pen and the national rallies, you say, being in a very strong position. Now, do they get enough to actually take control of the National Assembly, which is the House of Parliament that actually matters, that really has the power in France? It's a big step for them. It's not clear yet if they'll do it, so it's really too early to say. But there's enough of a worry that might happen that it really has caused a lot of people to frankly panic. You saw big sell-offs in stocks. You saw sell-offs in bonds last week. Things have calmed down today, but people really are quite worried about what might happen, who might take control, if anyone, and if so, as you pointed out in the run-up to this, sort of what their fiscal policies might be and what they might do were they actually to take control in France.
All right, Alan, thanks very much. Bloomberg Paris bureau chief Alan Katz talking to us about what's going to happen in the French elections. Kristina Hooper still with us, Invesco chief global market strategist, and you truly have global perspective at Invesco, and in the past you were at Allianz and other big global investors. Does what happens in France really matter to U.S. assets? Does it matter to Americans?
Well, it is mattering just in that we are seeing some flows into the U.S. as sort of safe haven trades because of fears around what's happening in Europe. I think it's very short term, but yes, in that way it does have an impact.
In your note that I was reading this morning, you said divergence has reemerged as a theme. And you certainly saw that before this, right, with the ECB cut and
Sure.
The Fed's not ready yet. Does this amplify that?
Oh, absolutely. I mean, what we're seeing happening in elections is definitely amplifying it. We might see a number of different economies moving in the same direction in terms of that pull towards the right, but it's happening in different ways and at different times over the course of, I think, will continue to evolve this year. So that adds to the divergences, but this could be very short-lived in nature. We could see that the result of the French elections winds up being something similar to a Giorgia Meloni kind of event, where we have a more centrist party, and there really wasn't cause for the kind of concerns that many investors had. We'll see, but I do think that primarily for me, the divergences are around the economy and the monetary policy reaction.
In terms of policy, it used to be when I was a kid that the right wing, at least in this country, believed in free markets, right? Open border, trade, and now nobody buys that. It's all about protectionist tariffs and, attracting businesses. The Biden administration has put out a ton of money to attract businesses to manufacture here in the U.S., so much so that Europe is very angry about it. Does that continue no matter who gets elected?
I suspect it will in the shorter term. I mean, what we saw in 2023 was pretty amazing. 70% of the industrial policies were created by developed economies. And in fact, if you look at the big economies, the majors, the US, the European Union, and China, they were responsible for 48% of industrial policies. That's unusual if we look at history, and I think speaks to this desire for some level of protectionism, the intersection of national security with economic interests. All kinds of things are happening. They're happening largely in developed economies, and so we're seeing some definite trends that I don't think die tomorrow, but might not last more than a few years.
All right, thank you for tempering my sensationalism a little bit. Kristina, great having you on the program. Thanks so much for joining us. Kristina Hooper there, Invesco Chief Global Market Strategist. Coming up, we're going to give you the morning calls, and then later Sarah Hunt of Alpine Saxon Woods joins us on tech's momentum and whether it still has room to run. This is Bloomberg. Futures searching for direction. We're going to get a lot of Fed speak this week, so that could move these dials. But right now, S&P futures just down a little bit, partly on concern out of France, although you would expect that concern to drive assets out of Europe and into the U.S. Rather than weighing on our markets. Let's get to the morning calls right now. I'll look at some of the analyst recommendations on Wall Street this morning. First up, UBS upgrades Best Buy to a buy from a neutral, raising the price target to $106. The analyst sees higher levels of product innovation, including AI and growing sales of new categories like e-bikes and furniture, driving more shoppers to Best Buy. Next up, Citi upgrades Capri, parent company of Versace and Jimmy Choo, to a buy from a neutral with a price target of $41, citing potential upside regardless of Tapestry's deal to buy the company. This is the countdown to the open. I'm Matt Miller. We are moments away from the start of trading. Looking for some direction today. The concern in Europe weighing on S&P futures right now. The Stock 600 dropping, whittling away the gains that it made earlier this morning, and that puts some pressure on S&P futures, although maybe that turns around and that money comes out of Europe and comes into the U.S. There you hear the opening bells on the New York Stock Exchange and the NASDAQ market sites. Let's take a look at some of the other assets that we're following this morning. Speaking of the move in Europe, we see the euro back down below $1.08 right now at 107.18. The U.S. 10-year yield at 4.27, 4.28, and NYMEX crude right now up 0.75% at $79.05. One of the stocks that we're watching closely this morning is Autodesk, the maker of engineering software, rallying after activist investor Starboard takes a $500 million stake in the company. Joining us now to talk about that is Bloomberg's Abigail Doolittle. Abby?
So shares are rallying, but I don't think that this news is a surprise to everybody, because if you take a look at the stock on the month, it is heading to its best month since July of 2022, up about 17%. Today, it's its fourth up day in a row. So again, I think that some folks had known about this, but what we're talking about is that roughly $500 million stake by Starboard Value in Autodesk, the engineering software company. They are saying that some of the company's performance metrics, not great, but they are also pushing for changes on the board. In fact, they are filing a lawsuit against the company to delay the annual shareholder meeting, saying that some accounting probe issues had been disclosed really at the last minute of when they could actually seek a change on the board. In return, we've had some comments from Autodesk recently saying Autodesk is, quote unquote, confident in the direction after the Starboard letter. Starboard pushing for these changes, investors liking it, thinking that things could change on the year. This is one stock that is underperforming down, but certainly today up 4%. And again, in the month of June, up about 16%.
All right. Abigail, thanks very much. Abby talking to us about Autodesk. Let's talk about Broadcom. It's the latest company to be caught up in the AI boom. It had an amazing week last week, and it's moving a lot this morning as well. Here's Bloomberg Katie Greifeld with more on Avgo.
Yeah, Broadcom building on its record run here. Broadcom, of course, it supplies chips to companies such as Apple, so it has some big clients there. It surged by 23% last week. That, of course, was a record weekly performance. That's after it reported a beat and raise quarter. So let's go through just some of the numbers there. Sales in the full fiscal year, which runs through October, expected to come in at about $51 billion. Analysts had projected about $50.6 billion, so a beat there. And Broadcom, it finished Friday at an all-time high. It's up another 3.5% or so today, right now, with the AI hype cycle in full force. It's up 56% year to date through Friday's close. And as such as NVIDIA, Broadcom also planning a stock split, that 10-for-1 stock split. It becomes effective on July 15th. So it's going to be interesting to watch the action between now and then, Matt.
You know why the ticker is AVGO?
You know, I was hoping you would tell me.
Because, well, I think you were at Haverford at the time, that Avago bought Broadcom.
Yeah.
They said, we're going to keep our ticker, but your name.
I was not paying attention, so I appreciate that.
Katie Greifeld, thanks very much. Finally, it's been a scary few days for Monster Energy. The stock has been sliding on concerns of slowing growth in the U.S. energy drink sales market. Here with more is Bloomberg's Isabel Lee. Isabel?
Hey, Matt, shares are now kind of flat. Stifel cut their price target for the stock to 57 from 63, but it maintained its buy rating. So the new price target implies around a 20% upside from where the stock last closed. So this follows really multiple price cuts. We've seen last week MKM Roth slashing their price target to 56 from 59. This analyst there is concerned over slowing growth in energy sales in the U.S. The analyst said that if this continues to eat up the market share, then it's going to be harder to justify the multiple expansion of the stock. We also have Jefferies also cutting its price target, but maintaining its buy rating. The company cut its target to 61 from 68. So highly caffeinated energy drinks really have seen a softening in demand in the past few months. That says consumers try to shift to more healthy options, and also as the regulators hone in on this segment. We have the UK party, for instance, last week saying that if they win the elections, they will consider banning the sale of highly caffeinated energy drinks to teenagers. So that's one thing to watch. That's in the UK, of course, but who knows if it will follow here in the US. For now, the Monster strategists are kind of bullish on the stock. We have around 17 buys, 10 holds, and just 1 sell. Monster is down now 16% year to date, though. Shares are now edging slightly higher by 0.5%, Matt.
All right, Isabel, thanks very much. Isabel Lee there talking to us about Monster and other highly caffeinated energy beverages. Joining us now is Sarah Hunt. She's a partner and chief market strategist at Alpine, Saxon Woods. And Sarah, a couple of those stories were big momentum moves, not both in the tech sector, but we've seen that obviously with AI as well. So much momentum. Does that continue? Because we've had a real run-up in valuations, certainly for the Magnificent Seven, which is now looking at a PE of 36 times trailing earnings.
Well, I think what's interesting is the Broadcom news that you just mentioned, which is that you've seen a big rally in that stock. So I think that what's going to continue to happen is that people are going to latch on to different companies within the space and say, hey, wait a minute, this one hasn't moved like the rest of them. We had some Broadcom widely across the firm. So, of course, we're happy with that. But I do think that there is a risk that as these stocks get pushed higher, those earnings really have to come in to support the levels of prices.
I wonder what, last night I was reading Julian Emanuel's note, he from ISI raising his price target to 6,000 for the S&P, but really it's all about obviously AI and this space, and he says, the gains from AI are going to come early in its development. Do you agree with that? I mean, it's obviously a process. We know at Apple, for example, it's going to take years for them to roll out their AI strategy, and they're just partnering up, not even using their own goods, really. But do you believe that the gains in terms of the stock market and the bond appreciation are going to come early in that development?
Well, certainly for the stocks that participate early in the development. So right now, who are you seeing rally? You're seeing the companies that have the most skin in the game in terms of sales being rocketed by the fact that people need more of these chips. They need more memory. They need certain things that go along with deploying the assets to begin with. Then you're going to have to see the development of how am I monetizing this when I'm not the company that's making the chips, or I'm not making any of the ancillary products that go into creating AI servers. And those companies now capitalize on the investments that they're making in the future. And that's why it could have a very long tail. But I also see the point of saying right now you're seeing the big gains in the companies that are in the early parts of it, because those are the companies that are getting paid right now for AI chips.
Does it matter if we get rate cuts, Sarah? I mean, in order for the bullish case to play out, do you have to have the Fed play along?
I don't think in the technology space you need to have the Fed play along, because right now there's a secular story going on in that part of technology that is encompassed in this AI situation that is different from the rest of the market. Does the rest of the market need rate cuts? I think they certainly, certain aspects and certain sectors of them do. We're going to have to see how inflation plays out. And I think the benign inflation report on Wednesday was helpful to the Fed, but it's just one after several non-benign inflation reports. So I think that for the rest of the market, yes, for Main Street, certainly a rate cut would probably be welcomed. But for the technology juggernauts right now, they're dishing off a lot of cash from all of this. I don't think that the rate story is what is important to them.
In terms of the tech sector now versus, Y2K, and people are making that comparison a lot, right? Because valuations have shot up here to 20 plus over the past only 150 days, and the same thing happened previously. Is there a difference in that these companies are actually making money, Sarah? Because, during the 1999-2000 boom, it seemed like driving revenue higher was the only important aspect, and there was no focus on profits.
I think that's a big differentiation, and I think that's one of the reasons that people are less worried about the valuations here as they were in that time frame. You also saw in that time frame a lot of large companies that were selling equipment, financing their own customers. And right now you have a very different situation, because the biggest buyers of some of these chips and servers are the largest companies that have a lot of cash. There's no need for companies to borrow to buy AI chips, for example. So I think it's a very different drop, and you have a much bigger, more concentrated tech picture and a much more concentrated customer base. And while there is some risk in that, it's certainly the best customer base to have right now, because it's a base that has an enormous amount of cash and a willingness to spend it.
Are you talking about other businesses like B2B commerce, or do you mean consumers still have enough cash and are willing to spend it?
I think for the current AI boom in the chip space and in the server space, the companies that are buying things like Google and Meta and Amazon all have enough money to have a large CapEx program to start putting some of this stuff into place. And back in the 2000s, you had a lot of companies that were financing their own customers because the customers wanted to deploy switches and they wanted to deploy dark fiber, but they didn't necessarily have the revenues that were commensurate with their needs. And I think right now you see that. And I think on the Apple side, you've seen a little bit of consumer enthusiasm for the changes that Apple is going to bring. So I think, AI has been a part of the consumer technology world for a while. It's just the large language models that have made it much more approachable and or much more able for people to understand what's going on there. So I think that there's a willingness for people to spend on technology. There's certainly a willingness for the large tech companies to deploy capital in specs to continue to add to their capabilities. So I think that that's a little bit of a difference from the last cycle.
Right. I can understand that, companies are waiting in line to get their hands on as many chips as they can. They want to have space at server farms, et cetera. But I just wonder about the strength of the consumer. UBS, I was just saying this morning, upgraded Best Buy because they expect droves of consumers to go in, or at least online, and upgrade PCs to AI capable. We've seen this, with Dell and others. But does the U.S. consumer really have enough money to participate in this upgrade cycle? We have worked our savings down to zero, and you no longer have the stimmies that you had during the COVID period. So can we still buy as much stuff as Wall Street needs us to?
Well, I think there's been a lot of discussion about the bifurcated consumer and the fact that on the low end, you're seeing a lot more pressure. You're seeing a lot more pressure for folks that have not kept up necessarily with wage growth as everybody else has. And on the high end consumer, you're seeing a very high propensity to spend. So I think on that technology side, and certainly the way certain things like your phones are no longer subsidized by the carriers, but at the same time, they've made payment plans. So I think that people do have an urge to get the latest and greatest, and they don't want to be left out. I think there is a propensity for that consumer to continue to spend, even though the savings isn't as strong as it was. And I think to the extent that you had a huge upgrade cycle on the PCs when we had COVID, at some point, now you're 3-4 years after that, everyone buying an extra computer because they needed one. I think there probably is some room for additional expense, especially if people think that they're going to get some hot new ability to use that technology.
Sarah, what do you think about diversification now? Bloomberg had a great story by Lou Wang a couple of days ago about the fact that, if you put all your eggs in one basket, just buy a stock tracking fund, you've trounced any kind of asset allocation fund. But it doesn't feel safe to do that. Do you go for the convexity trade? Do you look at amplification in AI specifically, or do you think diversity is still the right way to invest?
Well, I think that you always have to have a mix, because in the end, yes, this has been fantastic. And if you were just looking at the Qs over a period of time, you could say, well, that's trounced everything. But that doesn't always last forever. And especially when you start to see valuations get a bit stretched, at some point, there's going to be a digestive period. Even if there isn't a big drop in the market, there's certainly going to be some sort of consolidation. And that's when you also want to have some participation in other areas. And I think right now that's been the big challenge, because the economy, the data is coming in somewhat mixed. People are a little bit concerned about what's going on outside of the technology front. But the valuations in the non-technology sectors are not nearly as daunting as some of the technology valuations. So I think you absolutely have to participate in the technology, but I don't think you want it to be the only thing that you have. And certainly you've now got a fixed income component to a portfolio where for a while you didn't even have that as an option.
Sarah, great getting some time with you. Thanks so much for joining us. Sarah Hunt there, Chief Market Strategist and Partner at Alpine, Saxon Woods. Coming up, Bill Gates is ready to go nuclear.
Of all the climate-related work I'm doing, I'd say the one that has the most bipartisan energy behind it is actually this nuclear work.
Why he's ready to put billions more into a next-generation power plant next. This is Bloomberg.
Of all the climate-related work I'm doing, I'd say the one that has the most bipartisan energy behind it is actually this nuclear work. If we unleash the innovation power of this country, we tend to lead. And I feel great about the support we're getting from the federal government in this nuclear space.
Bill Gates betting on nuclear power, plowing billions of dollars into a plant in Wyoming. His startup, TerraPower, broke ground last week for the construction of a commercial reactor in the state. Joining us now is Bloomberg Power and Renewable Energy editor Will Wade. I'm so glad to get you on the show because I was listening to you on Bloomberg Business Week with Carol Massar and Tim Stenovec. You had gone out to see a new reactor brought online. Not one of these new kind of fancy Bill Gates reactors, but like an old school one, right?
Yeah, I was down in Georgia a couple weeks ago to see the Vogtle 4 project, which finally came online. It was 7 years late. It was way over budget. It was like more than 100% over budget. And it's huge. It's, it's a giant gigawatt plus reactor. This TerraPower one that Bill Gates is building is more 300 megawatts, so it's much smaller, and it's a much different technology that they're trying to build.
But the thing that struck me is when you went to see the Vogtle reactor open in Georgia, you were like, nobody else is opening these, right? It's obviously, it's so late, it's so expensive. Who wants to get into that? Now here comes Bill Gates, and he's like, I want to get into that, not on that gigawatt level, but at a smaller level, and he wants to do many. So is it possible that this could pick up, that it could catch on?
It's possible. I mean, the thing that you need to keep in mind is it's all about climate change, because nuclear is carbon-free power that runs around the clock. Wind and solar don't run around the clock. Hydropower does, but it's hard to find places for it. Only nuclear can do that, but it is expensive and slow to build today. In the future, in theory, once we get these things going, they should be able to be built faster and quicker. But right now, it's sort of all new technology, new build, and everything that new is, slow and time-consuming.
Well, and what about the waste? Is there still that problem of where to put the spent, uranium or whatever, or have they dealt with that?
Oh no, it's still there. Every nuclear power plant has old spent fuel rods sitting out back, and they're going to be there. But I think they're going to
be there for a while. Huh?
Well, I mean, they're going to be there for a while, and it's deadly for thousands of years. But I look at it this way: like, everything is dangerous. If you live near a coal plant, the emissions are bad. You're likely to get asthma. Gas plant, everything in the world is dangerous. Nuclear is also dangerous, but they take the waste issue very seriously, and there's not that much of it.
Well, okay, so if not the waste being a problem, I grew up in the wake of 3 Mile Island, as did you.
Of course.
We all saw Fukushima rock the markets, and they're still recovering from that. Can that part of it be contained? Well, with new technology, right? This is what I'm wondering, because Bill Gates is kind of a preacher in terms of nuclear can be safe. Nuclear is clean. So is he right?
Yeah, there's definitely ways that you can design new plants that they are safer. Nothing in the world is 100% safe, even if you stay in your bed all day. But the new plants, they are safer. They have a lot more advanced designs, like the ones that, if you lose the electricity, the gravity will sort of keep water flowing to keep the fuel cooled and safe. So they're not as risky as some of the old school reactors that we saw in the 70s.
This new one doesn't even use water, right? It uses like molten salt.
Molten sodium, yeah. Well, it's got liquid sodium as the coolant instead of water, so that lets it get hotter, and that makes it more efficient. Plus, it has this storage tank of salt, so you can get extra power from it if you need to.
It's such a cool science, and I'm so glad that we have you covering it, Will. Thanks so much for coming on the program. Bloomberg's Will Wade talking to us about Bill Gates' ambitions for clean nuclear power, hopefully safe as well. For some of the sector price action that we're watching in the market this morning, just 22 minutes into the session, let's get over to Bloomberg's Abigail Doolittle. Abby, what do you see?
Well, we're looking at another small decline for the S&P 500 right now, on pace for a second down day in a row. Somewhat broad-based from a sector standpoint: real estate, communication services, utilities, healthcare, materials, tech, and discretionary all lower. Real estate down the most. Yields are popping higher today, as you know, so that, of course, makes those stocks look less attractive given the real estate play plus the dividends. On the upside, energy, but up just a little bit, up 0.3%, and then 3 other sectors a little bit higher as well. Let's take a look at one sector that is underperforming, however, and that is biotech. The biotech index down for a second day in a row, the worst 2 days going back for about a month or so. And it doesn't seem to be anything so macro, but there's lots of news at a micro level, including Takeda's epilepsy drug. Their phase 3 trial didn't meet the primary endpoint, and that stock and some other stocks down significantly, weighing on that biotech sector, Matt.
All right, Abigail looking at the sectors for us. Coming up, Fed officials return to the public speaking circuit. Did they ever leave? The market moving events you need to be watching. That's next in our trading diary. This is Bloomberg. Time now for the Trading Diary, what you need to be watching today and this week. We get Fed speak from Williams, Harker, and Cook later today. Tomorrow, we get U.S. retail sales, so watch EcoGo on their Bloomberg terminal. We get Eurozone and inflation data out of the Eurozone, so, pay more attention this week than you typically would, considering what we're seeing in rates and stocks over there. Wednesday is Juneteenth, so the markets will be closed. And hopefully you stay home and commemorate that in some way other than going to work. Thursday, we get the BOE rate decision. London Stock Exchange just overtook Paris as Europe's largest. So England continues to be important. This was the Countdown to the Open. I'm Matt Miller, and this is Bloomberg.